Do you want to start investing, but unsure where to begin? The world of investing can be exciting, but it's also filled with traps that can cost beginners a lot of money. Many newcomers think they're doing everything right until they realize they've fallen into the same mistakes that have ruined others' financial futures. But don't worry, you don't have to make those same mistakes. In this video, we'll dive into the top 5 investing errors beginners often make, and more importantly, how you can avoid them. By the end, you'll have the knowledge to make smarter, more confident decisions with your investments. Let's get started. 1. Chasing quick profits without a plan. The first and most common mistake beginners make is chasing quick profits without having a real plan in place. When a stock or crypto token starts soaring, it's easy to feel the urge to jump in, driven by greed and the fear of missing out. It feels exciting at first when you see green numbers, thinking you've made the right choice. But without a plan, emotions take over, and emotions are the enemy of smart investing. A beginner who buys without a strategy often doesn't know when to sell, how much to risk, or what role that investment plays in their overall portfolio. When the market turns, panic sets in, and they sell at a loss, often right before the asset recovers. This isn't investing, it's gambling. Real investors don't rely on luck. They follow rules and strategies, setting clear entry points and planning their exit in advance. Without discipline, beginners end up victims of their own emotions. If you don't have a plan, you're planning to fail. The market will teach you that lesson the hard way. 2. Ignoring diversification. Next up is ignoring diversification. A common mistake many beginners make is putting all their money into one asset, hoping that one stock or cryptocurrency will make them rich. When that investment performs well, the excitement can be overwhelming, but what happens when it crashes? In an instant, years of hard-earned savings can vanish, leaving you with nothing but regret. This is why diversification is so crucial to smart investing. Diversification is a practice of spreading your investments across various asset classes, industries, and even countries. By doing so, you protect yourself from the risk of massive losses. Think of it like insurance. It may not seem exciting, but it can save your financial future when disaster strikes. History is full of examples of companies that were considered too big to fail, yet they collapsed overnight, wiping out investors who had all their money tied up in one place. Companies like Enron, Lehman Brothers, and FTX are all examples of how quickly things can unravel. The key to building wealth is not relying on one big win. It's about consistent, steady growth through many smaller wins. When you spread your risk, you give yourself the best chance to continue growing your portfolio, even during market downturns. Diversification ensures that if one investment falters, the rest of your portfolio can help cushion the blow. Remember, never put all your eggs in one basket, because the market has a way of flipping those baskets when you least expect it. Stay balanced, and your investments will continue to grow, giving you peace of mind for the future. 3. Trying to time the market. One of the biggest mistakes beginners make is trying to time the market. Many newcomers believe they can outsmart the market by predicting its highs and lows, hoping to buy when prices are low and sell when they're at their peak. The allure of getting the perfect deal is strong, but the truth is, timing the market is nearly impossible, even for seasoned experts. Markets are unpredictable, and even the most experienced investors struggle to pinpoint the exact right moments to buy or sell. In fact, missing just a few of the best-performing days in the market can drastically reduce your long-term returns. The reality is, markets move in cycles that no one can consistently forecast. Trying to time the highs and lows often leads to missed opportunities and unnecessary stress. The best strategy is not about timing the market, but about being consistent with your investments. By committing to invest regularly, regardless of market conditions, you minimize the impact of short-term volatility. This strategy is known as dollar-cost averaging, where you invest a fixed amount of money at regular intervals. Over time, this ensures that you're buying at highs and lows, which helps to smooth out the effects of market fluctuations. Beginners often waste years waiting for the perfect moment to invest, believing they need to time it just right. But disciplined investors who stick to their investment plan are quietly building wealth over time, while those who chase perfect timing are often left behind. The market rewards patience, not prediction. If you focus on consistency rather than perfection, time becomes your ally, and compounding will turn small, steady contributions into life-changing wealth. 4. Letting emotions drive your decisions. One of the most dangerous mistakes any investor can make is letting emotions dictate their decisions. Fear and greed are powerful emotions that can lead to irrational and impulsive choices, which ultimately harm your investment strategy. When the market dips, many beginners panic, selling their assets at a loss, only to watch prices rebound shortly afterward. On the flip side, during market rallies, greed takes over, and beginners often buy into the hype, purchasing assets at their peak value, only to see their investments lose value soon after. This cycle of buying high and selling low not only damages your portfolio, but can also shake your confidence as an investor. Markets are inherently designed to test your emotions. During downturns, headlines scream panic, amplifying a fear that investors feel. During booms, media outlets hype up the excitement, making people feel they need to get in on the action before it's too late. If you allow these emotional triggers to drive your investment decisions, you'll constantly find yourself on the losing side of the trade. The market doesn't care about your emotions, and neither should you. Smart investors rely on discipline, patience, and a well-structured strategy. They stick to their plan regardless of how the market looks in the short term, understanding that market crashes are temporary, but mistakes driven by fear or greed can have permanent consequences, is vital. The key to long-term success is not just about making the right moves, but also about controlling your emotions and trusting your strategy to navigate the ups and downs of the market. When you learn to stay calm, you're setting yourself up for sustained growth and financial security. 5. Skipping the education process. Finally, one of the biggest mistakes beginners make is failing to invest in education before diving into the market. It's tempting to rush in, especially when you see others making money from stocks, crypto, or real estate. But rushing without understanding the basics is a recipe for disaster. Many beginners think they can rely on hype, rumors, or influencer advice, assuming they'll get lucky. However, this approach is nothing short of gambling with your hard-earned money. Investing without proper knowledge is not only reckless, but the market will also punish you for your ignorance. Successful investors dedicate significant time to learning. They don't just invest because they've heard of an asset. They take the time to read financial reports, study market cycles, and understand the fundamentals behind every investment decision they make. They are constantly learning because the market is always evolving, and staying educated ensures they're prepared for whatever comes next. Education isn't just about theory. It's about building the skills to analyze trends, make informed decisions, and avoid impulsive choices driven by emotion or hype. By educating yourself, you gain a massive edge over those who rush in without understanding what they're doing. Every book you read, every course you take, and every menu you learn from adds to your investment toolkit. This knowledge transforms risks into opportunities and mistakes into valuable lessons. Ignoring education guarantees costly errors, but embracing it sets you apart as a serious, strategic investor. Knowledge is the real shortcut to success, and it's the foundation for long-term wealth creation in the market. Now that you know the top 5 investing mistakes beginners make, it's time to take control of your investing future. Remember, investing isn't about making a quick win. It's about avoiding costly mistakes, staying disciplined, and learning from those who have succeeded before you. Build your plan, diversify your assets, stay consistent, control your emotions, and keep learning. These principles will help you become a successful investor over time. If you found this video helpful, hit that like button, subscribe for more financial tips, and share this with someone just starting their investment journey. They'll thank you later. Thanks for watching. I shall see you in the next video.